Microsoft recently revealed plans to invest $80 billion this year in constructing data centers for training artificial intelligence models and handling both AI-driven and cloud-based applications worldwide. More than half of this amount will be allocated to projects within the United States. To put these figures into perspective, the $80 billion investment surpasses the entire gross domestic product of several nations, including Croatia and Lithuania. Microsoft's Azure Cloud division has been a major force behind this AI momentum, achieving a 33% rise in revenue over the past year. Meanwhile, usage of Azure OpenAI has doubled over the last 6 months, although the company has noted that demand exceeds current data center capacity. Evidence of an upcoming expansion can be seen in the $108.7 billion in finance leases set aside for data centers yet to be built. These commitments, which will roll out between fiscal years 2025 and 2030, span lease terms from 1 year to 2 decades, underscoring the scale of Microsoft's dedication to AI infrastructure. Before we begin, this video is not an investment advice and must do your own diligence. However, with my experience investing for years, the content from this video has a solid research foundation. Check our Patreon on the description below for an inside members-only access on what are the best buys now. We will also update you on what to sell for gains or to avoid losses. Subscribe to our channel so you will never miss out. Microsoft appears poised to gain from expanding data center investments, driven by the strong demand for its cloud services. A substantial share of these expenditures is likely to flow toward graphics processing units and AI accelerator chips, areas where Nvidia excels. Although not all of the projected $80 billion budget will be directed at GPU technology, a significant portion is expected to do so. Looking back at Microsoft's financial data through June of its fiscal year 2024, the company spent $44.5 billion on capital expenditures, mostly for data centers and cloud infrastructure. Around half of this spending was allocated to assets with long practical lives, while the other half supported CPU and GPU servers. During that period, Microsoft also emerged as Nvidia's top customer, reportedly purchasing 485,000 GPUs, more than double what the second-largest customer acquired. This level of demand suggests that Microsoft is preparing to increase GPU purchases even further in 2025, indicating a substantial opportunity for Nvidia. Additionally, Microsoft's ongoing finance leases point to continued data center investment, implying no slowdown in spending. Out of $40 billion allocated to long-life assets, less than half of those leases are scheduled to commence this year. The announcement of a large-scale spending plan could inspire other major cloud and tech companies to invest more in AI infrastructure as well. Leading tech firms have made it clear that underspending on AI poses more risk than overspending, and competition in the AI space remains intense. Consequently, other hyperscale providers may also escalate their data center and AI-related outlays. Nvidia retains a dominant position in GPUs, commanding around 90% of the market. Its CUDA software platform enables developers to tailor the chips to various tasks, creating a durable competitive advantage. Although competitors like Advanced Micro Devices offer alternatives, Nvidia's strong software ecosystem keeps it at the forefront of AI infrastructure technology. Custom-built AI chips, engineered by companies such as Broadcom and Marvell Technology, do pose a challenge. These specialized chips excel at certain tasks, but they are tailored to specific customers. By contrast, for large-scale AI deployments that need rapid implementation, Nvidia's GPUs remain the most flexible and straightforward option. Consequently, Nvidia is likely to sustain a considerable share of the AI infrastructure market. Nvidia holds significant potential as companies around the globe continue to allocate substantial resources toward building artificial intelligence infrastructure. The fact that its primary client is dramatically increasing its spending in this arena indicates that this chipmaker may experience considerable growth in 2025. Currently, Nvidia's shares trade at what many see as an appealing valuation. Analysts project a forward price-to-earnings ratio of roughly 31.4 for 2025, accompanied by a price-earnings-to-growth ratio of 0.98. A PEG below 1 often points to undervaluation, and many high-growth stocks command PEG ratios above that threshold. Given Nvidia's status as a leading beneficiary of an $80 billion data center expansion, and considering its stock remains attractively priced, this company stands out as a strong choice for investors seeking growth. Give us a like if you like our video, subscribe, and ring the bell to never miss out. Check our Patreon for an inside look on what are the best buy and sell stocks every week.